And so people are right when they say this time is different, but price still does the same thing. And so whether this time is different on some different news, I totally think it is going to be different news. I think we're going to start to see the AI bubble unfold. I think we're going to probably see poor economic data potentially start to roll out, and we're going to see another big sell-off. And I do feel like this time around is not just a buy the dip. I always look at like the stock market like the ocean. When the tide goes up, what happens to all boats? And so it's the same with the stock market. If the stock market is in a rising tide, pretty much most stocks are going to want to go up. And you don't want to bet against a rising tide. It's pretty much a force to be reckoned with. So right now, the underlying trend based on the 150-day, based even on the 50-day moving average and the 20-day moving average being above it, it's still telling us the trend is still rising. So the market is taking a big breather. It is showing signs of weakness. It is a concern, but I don't change positions until proven wrong, until the trend says, okay, the uptrend is now over, it's stalled out, and it's actually started a downtrend. And that's when I get out. And that's a big difference between a lot of investors. Like, for example, a lot of people always try and pick bottoms on big sell-offs. They try to pick tops, which is a very difficult strategy. We wait for a bounce to turn into a rally. We've been playing this market all the way up, and we're not going to get out of it until it probably breaks down, and then we have a sell signal. It's not about trying to get in at the bottom. It's not about trying to get out at the top. It's trying to catch this middle safe section. And what I do that's a lot different than most other people in the technical space and investing in general, trading, is I follow price. I don't try to predict where things are going and get in position. I literally let the market turn a corner, change direction. And if the trend is strong enough, I jump on, I ride it up like this in this scenario. And when the trend changes direction and breaks down, I will step off. And I just know it's part of the game. You have to give back some of your gains in order to know that the trend is actually reversed. And of course, we never get in at the bottom. So we're never going to catch the bottom with this philosophy, this strategy, but it allows you to catch the middle sections. And that's my core focus and why we're still long. The trend is up. We are going to ride the trend until proven that it has changed direction.
Many investors attempt to predict exact market turning points. They try to buy at the very bottom of a crash or sell precisely at the peak of a rally. In reality, those perfect entries and exits are extremely rare. A more disciplined strategy focuses on capturing the middle portion of a trend, the period when momentum is already established but not yet exhausted. Instead of predicting where markets will go, traders wait for confirmation that a new direction has formed. This approach accepts that some gains will be missed at the beginning and the end of a cycle. However, by following price trends rather than guessing future moves, investors aim to capture the most reliable and sustained portion of market growth.
Yeah, so the Nasdaq definitely showing a lot more weakness. We're seeing a lot of big tech, SaaS and Magnificent Seven, all of that starting to break down. If you were to take a look at kind of a key pivot zone across this chart, if we look at this upper range here, price is generally kind of bouncing above it. And now price is actually kind of broken down and it's bounced up and it's hitting its head on resistance here. So this is definitely not a good sign. And it's actually making a series of lower highs. It's making a series of lower lows. That is the definition of a downtrend. And so the Nasdaq is in a short-term downtrend, whereas the S&P 500 is still kind of holding up from a technical level and cycle level. The Nasdaq has been rejected. We have the 20-day moving average breaking below this 50-day. These are all a lot of technical lingo, but more or less moving averages give you an idea of long-term, short-term, and very short-term trends. And so we definitely have the Nasdaq in a downward bias. It hit resistance. It got rejected. And the next significant support level is going to be somewhere right across here, around that 24,400 or 500 level for the Nasdaq. If it breaks below this, we're going to see a very precipitous fall. And of course, if it breaks down, then we're going to see the S&P 500 break down. They pretty much move together. But the fact that the Nasdaq is showing weakness, it's leading the way to the downside, is not good, because the Nasdaq is a heavyweight boxer. And when it goes down, man, it pulls the other indices down with it, because it has the Mag 7s in it, and it's very heavily weighted with some big players in there.
While the broader market still shows resilience, signs of weakness are emerging in key sectors. Technology stocks, particularly those dominating major indices, have begun to lose momentum. The technology-heavy Nasdaq Composite has recently displayed patterns associated with short-term downtrends, including lower highs and lower lows. This development often signals growing selling pressure. Because technology companies carry significant weight in market indices, weakness in this sector can have wide-ranging consequences. If the trend continues downward, it may drag other indices along with it. For investors monitoring market stability, the behavior of technology stocks is often an early warning signal.
Yeah, so the Mag 7 has already done what the Nasdaq, I think, is about to do. So we saw this topping formation in the Mag. This is the Mags ETF, which is a basket of the Mag 7s. It has already broken this support level, and it's clearly broken to the downside with strong volume. So this is not good. The Mags are going to lead. The Nasdaq should follow suit and break down, and then we'll see the S&P 500 break down. I think that's kind of where we are about to see things head. And so that is the case. Obviously, the AI is wreaking havoc in all kinds of different sectors. It seems like every week there's a huge new player that steps in for taxes or for SaaS in general, businesses, and we're seeing it just hit the software space. And so people are moving away from technology. And the Magnificent Seven have traded sideways for so long. I think the AI has lost a lot of its shine. Bitcoin lost a ton of its shine a long time ago. Gold got a lot of attention in Magnificent Seven. And now the Magnificent Seven feels like it's falling out of favor, a lot like kind of Bitcoin. It's just people they're not all that hot and heavy and excited about it anymore. And so they're starting to give up on it. And the concern with this is so many people, aggressive traders, a little bit more of people who chase returns, have been piling into this sector and these big heavyweights for a long time. And just like in Bitcoin, where everybody piles in and they want big returns or chasing big returns, the Mag 7 will be the same. As it breaks down and people start to unwind, just as everybody didn't care about paying high pricing and piling in, they're going to flood the market with sell orders. They're going to bail out and move out of it. And this is just typical price action. This is how markets move. This is not just based on aggressive traders. This is just how the mass psychology, when they move into fast-moving assets or sectors and stuff, they also move out of it very quickly at the same time. So the Magnificent Seven can drop quickly, which is going to pull the indices sharply lower here.
Another critical factor shaping the market is the performance of the so-called Magnificent Seven technology giants. These companies, Apple, Microsoft, Amazon, Alphabet, Meta Platforms, NVIDIA, and Tesla, have driven a large portion of recent market gains. However, when leadership stocks begin to weaken, markets often feel the impact quickly. Heavy investor concentration in these companies means that shifts in sentiment can trigger rapid price movements. If these market leaders continue to lose momentum, the ripple effect could extend across major stock indices.
Yeah, I do feel like I do feel like it's going to be very similar. There's going to be a very precipitous fall in price. Believe it or not, this tariff drop in the Magnificent Seven, in the Nasdaq, and in the stock market in general, I overlaid it once with right here. If you check this out, so this is the April sell-off you just talked about, John, the tariff drop of last year, and then take a look at COVID. And this is why, a lot of people always have this story in their head, and you hear it all the time. Everybody's like, this time is different. It's different news. It's like, everybody's like, it's always different. If you look at all of these drops in the market, you can go back to all kinds of them. They almost look the same. It doesn't matter if it is somebody changing some tariff rules or if it is a global pandemic. Price does one of two things. Either people are buying it and it's going up, or they're selling it. The stock market doesn't really care what the news is, and every correction is different. And so people are right when they say this time is different, but price still does the same thing. And so whether this time is different on some different news, I totally think it is going to be different news. I think we're going to start to see the AI bubble unfold. I think we're going to probably see poor economic data potentially start to roll out, and we're going to see another big sell-off. And I do feel like this time around is not just a buy the dip.
Market trends are not driven solely by economic data. Investor psychology plays an enormous role in shaping asset prices. Over the past few years, enthusiasm surrounding artificial intelligence has fueled massive investment flows into technology companies. But hype cycles often follow a predictable path. Early excitement drives prices sharply higher, attracting momentum traders seeking rapid gains. Eventually, enthusiasm fades as expectations become difficult to meet. When sentiment shifts, the same investors who rushed into the market may exit just as quickly. This sudden reversal of capital flows can accelerate declines, especially in sectors that previously attracted speculative enthusiasm.
I think the market could fall 20% here very easily, the MAGs, the Nasdaq, and it might have a strong bounce after that, but I do believe we are actually headed into something much more significant in terms of the market sells off and then eventually puts in some bounce, but I believe we're going to go into an economic reset, and it'll actually form probably some big topping pattern, some head and shoulders formation. And then when we break that neckline, we start a stage 4 decline, which is a financial reset. And that's when, unfortunately, it'll feel like 2008 again. It'll be layoffs galore, unemployment spikes, things will get really, really tough. And so that's what I see unfolding in the big picture. So do I believe this sell-off can be bought? I think it's a gamble. I think you might get a bounce, and it all depends on if it is a bounce or if it is going to get legs and want to go higher. But based on, global things happening, precious metals, what they're doing, the volume, the sentiment of people, cycles that I follow, it's more or less pointing to this time could actually be the top before we go through a multi-year recession and wipeout and a reset in a lot of pricing for pretty much every asset class.
Some analysts believe current conditions could signal the early stages of a larger market correction. Historically, significant downturns often begin with weakness in leading sectors before spreading across broader markets. If major indices break key support levels, a deeper decline could follow. In extreme scenarios, this process can evolve into an economic slowdown marked by falling asset prices, rising unemployment, and reduced consumer confidence. While such outcomes are far from guaranteed, investors are increasingly discussing the possibility of a broader financial reset. Understanding these warning signals may help market participants prepare for the next phase of the economic cycle.